Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 2, and this is Section E2, and this is an application topic. Calculate the carrying amount of investments measured at amortized cost, and prepare journal entries, and this is excluding impairment. We're going to talk about impairment in the next video. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour training webinar where we go over the key ingredients to passing the CPA exam. Again, it's only 1 hour, it is free, and we will teach you the key ingredients to passing the CPA exam. So make sure you go check that out, make sure you sign up for that, because we will teach you how to be effective and efficient with your studying. And we will teach you things like studying in the morning, studying the questions first, making sure you review every day, and things like that. So again, make sure you go check that out. Also, just letting you know, we will only be going over 5 questions in today's video, whereas SuperfastCPA Pro members will have access to the full 10-question video when we post it in the members forum. So if you like this, if you like our other videos, if you become a SuperfastCPA Pro member, you can get access to a lot of resources, including the full versions of these 5-question videos where we go over 10 questions. So with all that said, let's dive straight into the questions. All right, here we are at question 1, and one thing I want to point out before we talk about these questions is that when it says investments at amortized cost, almost always it's talking about held to maturity securities. So it's not talking about available for sale securities or anything like that. It is specifically talking about held to maturity. So I just want to make sure that that's clear. We don't really talk about that too deeply here because it's kind of just assumed that's what we're talking about throughout the whole video. So again, we're talking about held to maturity securities or bonds or whatever you want to call it. Okay, with that, let's talk about question 1. Something we always like to point out is read the last part of the question first. This is a great strategy. It doesn't always help. Sometimes you won't get enough context even from doing that. But a lot of times, especially on test day when you've studied everything, right, you will get a lot of context from reading the last part of the question so that you don't waste time as you're reading through the full question. You can kind of pick out what you actually need if you remember how to do it. So let's read this last part. What is the carrying amount of the investment at the end of year 1? Okay. XYZ company purchased a debt investment with a face value of $500,000 for $490,000 with a stated interest rate of 6% and a 5-year maturity. Interest is paid annually, and the company uses the effective interest method to amortize any discounts or premiums. At the time of purchase, the market interest rate for similar investments was 7%. What is the carrying amount of the investment at the end of year 1? Okay, so we are talking about trying to figure out what the carrying amount is. Like, did this change at the end of the year? Did it go up? Did it go down from the 500,000 or from the 490,000? You know, if you don't know how to do this, that's okay. We're going to dive straight into the answer to learn how to do this. And we're going to start learning about how you know it's a premium, how you know it's a discount, and how to actually calculate the amortization of premiums and discounts and things like that. So let's go into the answer and we'll learn how this works. All right, here we are. The answer is C. $494,300 is going to be what the new carrying amount is at the end of year 1. So let's walk through this. Again, this is kind of an intro. We're going to be learning this all the rest of the video. This investment was purchased at a discount. So it didn't tell us that specifically, but you could easily figure that out because the stated interest rate of 6% is lower than the market interest rate of 7% at the time of purchase. When the stated interest rate is lower than the market rate, the bond is less attractive, so it is sold for less than its face value or par value. You might see that. It's face value, par value, basically the same thing. In this case, $490,000 instead of $500,000. So because they purchased it for $490,000, but the face value, the par value is $500,000, it's a discount. And the reason that that's the case is, again, because the stated interest rate, which is how much the bond actually has, 6%, that's the 6% interest rate that the bond has, compared to the 7% market rate, which is better. That means that people aren't going to want to buy it as much as they would want to buy one that has 7%. So again, they're selling it at a discount. The discount of $10,000 is then amortized over the life of the bond, causing the carrying amount to increase over time as the bond's value moves closer to the face value. So we're going to increase the carrying amount each year to try to get it to the actual face value because, again, it was sold at a discount. Now, one thing I'm going to say about all of these questions that we're going over, the idea behind them is just to learn how to calculate the amortization each year. Don't pay too much attention to, is this actually going to end up at the exact amount that it's supposed to be? Like, is it going to end up at the exact par value? If you go too far into a lot of these, I'm pretty sure you won't actually get to the 500,000. So again, in the exam, it'll have that, but I'm teaching you how to do the amortization, which is the part that you need to know how to do. But the amortization and figuring out the carrying amount each year, you're going to be able to do that based on what I'm teaching you. So again, we're going to focus on how to do that. The effective interest rate method helps us compare the actual cash interest received based on the stated rate to the interest income that would have been received if the bond were purchased at market rates. So essentially what we're doing is we are taking the interest rate that they are actually having and comparing it to the market rate, and that's going to help us figure out how much the amortization is for the discount or the premium each year. So the interest income, and that's using the effective interest rate. The effective interest rate is the market rate, by the way, is calculated on the beginning carrying amount. So you use the market rate and you multiply it by the carrying amount, and that gives you $34,300 of interest income. The interest payment is based on the stated rate of 6% on the face value. So what you do, again, is you take the market rate, multiply it by the carrying amount, and you take the stated rate and multiply it by the face value. And then what you do with those two, so again, 500,000 multiplied by 6% is 30,000. You have to figure out what the difference is between these. So the difference between the cash received, which is this interest payment right here, and the interest income, which again, we calculated up here, and the interest income was again calculated using the effective interest rate. This represents the amortization of the premium or the discount. So this $34,300 of interest income less the $30,000 of interest payment is $4,300. So this $4,300 is what is going to affect the carrying amount. So the new carrying amount at the end of year one is $494,300. So that might have been a little bit confusing. We still have some more questions to do, and we're also going to talk about the journal entry so you can kind of imagine how this is all working together. But basically, just know that to figure out the amortization and therefore being able to calculate the carrying amount by using the amortization, you have to multiply the carrying amount by the effective interest rate, which is the market rate, and multiply the face value, the par value, by the stated rate, and then compare the two and get the difference, and that will inform you how much the amortization is, and that will be added or subtracted from the carrying amount to get you to the par value eventually. So again, if that was confusing, that's okay. We're going to go to another question and kind of keep hitting this and keep learning more. Let's go to question 2. All right, here we are at question 2. What is the carrying amount of the investment at the end of year 2? Okay, GHI Inc. purchased a debt investment with a face value of $1 million for $1,020,000 with a stated interest rate of 5.5% and a 5-year maturity. Interest is paid annually, and the company uses the effective interest method to amortize any discounts or premiums. At the time of the purchase, the market interest rate for similar investments was 5%. By the end of year 1, the investment's amortized cost has decreased to $1,016,000. So again, what is the carrying amount of the investment at the end of year 2? So this is very similar to the previous question. Now, the previous question was talking about a discount. You can probably guess this one's going to talk about a premium, but you treat it very similarly. If you want to try this, go ahead and pause the video and see if you can do this just based off what we learned from the first question. If not, that's okay. We're going to dive straight into this to see how a premium is treated compared to a discount. All right, here we are. The answer is C, $1,011,800. That is the carrying amount at the end of year 2. So let's walk through this. We're going to talk about premiums, and then we're going to talk about actually calculating it. This investment was purchased at a premium because the stated interest rate, 5.5%, is higher than the market interest rate of 5% at the time of purchase. So that's a way you can tell, even if you're, for some reason, aren't given the face value or the par value, you can tell if there's a premium if the stated interest rate is higher than the market rate, or vice versa for a discount if the market rate is higher than the stated rate. When a bond's stated interest rate is higher than the market rate, it offers more attractive interest payments than other similar investments available in the market. Investors are willing to pay more for this higher return, leading to a purchase price that is higher than the bond's face value, resulting in a premium. The premium is then amortized over the life of the bond, which means the carrying amount of the investment decreases over time as part of the premium is written off each year. The bond was purchased for $1,020,000 at a premium with a face value of $1 million. At the end of year 1, the amortized cost has decreased to $1,016,000 as part of the premium has amortized. So now that we have kind of gone over how a premium works, why there's a premium, let's talk through the calculation. It's a very similar calculation. You just are kind of going the opposite direction. So the carrying amount at the beginning of year 2 was $1,016,000. You multiply that by the effective interest rate, which is the market rate, and that gives you interest income of $50,800. The interest payment is based on the stated rate of 5.5% on the face value. So this is the cash that they're going to receive. This is the $55,000 cash that they're going to receive each year. This isn't going to change. $1 million multiplied by 5.5%, that's $55,000. Again, this will not change each year. This is the part that's going to change because it's going to be based off of the carrying value. Now we go down here. The difference between the interest income and the interest payment is how you know what to do to decrease the carrying amount with the premium. So the interest income, $50,800, less the interest payment of $55,000 gives you $4,200. And you use this $4,200 to reduce the $1,016,000 down to $1,011,800. and that is the new carrying amount at the end of year 2. And again, the reason that we're doing this is because with premiums, you started at a value that was higher than the face value. So as the years go on, you are amortizing that higher value down to the actual par value or the actual face value of the bond. So you're trying to get down from $1,020,000 to $1 million by the time the bond matures. And again, we're not talking about getting all the way to that maturity date. I'm just teaching you how to calculate the amortization of the premium or the discount each year. So again, that's how you do a premium. In the first question, we did a discount. I hope that's starting to make a little bit more sense. Let's go to the next question now. All right, here we are at question 3. What is the carrying amount of the bond at the end of year 3? Silver Ridge Inc. purchased a 5-year bond with a face value of $300,000 for $315,000 on January 1st, year 1. The bond has stated interest rate of 4% with interest paid annually each December 31st. Silver Ridge Inc. uses the straight line method to amortize the premium. What is the carrying amount of the bond at the end of year 3? Okay, so this is different. We've been talking about the effective interest rate method for amortizing these premiums or discounts. Now it's talking about the straight line method. To be honest, this is very easy. I bet you if you thought through it, you could, thinking about straight line depreciation and things like that, you could probably figure this out. So pause the video, go through this. Again, I think you could probably figure this out. If you have no idea though, that's okay. We're going to go straight to the answer if that's the case, and we'll learn how the straight line method works compared to the effective interest rate method. All right, here we are. The answer is B. $306,000 is going to be the carrying amount at the end of year 3. So let's walk through this. The straight line method is way easier. Probably it's more likely that you won't see something like this on the exam because, again, it's very easy. I wanted to make sure you know it exists though, just in case, but most of the time you'll probably be using the effective interest rate method, but just in case, I wanted to make sure that you knew that this existed. The straight line method for amortizing a premium, or a discount by the way, spreads the total premium evenly over the life of the bond. The premium is the difference between the purchase price and the face value of the bond. So again, this is very easy to figure out. You take the purchase price, the face value, and the premium is the difference. So $15,000, that's the premium. And since we're using the straight line, all we have to do is divide it by the maturity, and that gets you $3,000 of amortization on that premium each year until you get from the $315,000 that you purchased it for down to the actual face value of $300,000 at year 5. So what do? At the end of year 1, it's $312,000. At the end of year 2, it's $309,000. At the end of year 3, it's $306,000 because again, each year you're reducing the carrying amount by $3,000. So that's how that works with the straight line method. Again, way easier than the effective interest rate method. And you probably won't see it because it's a lot easier, but just in case, so you don't get thrown off, that is how you do it for amortized cost investments. Now let's go to the next couple questions, and we're going to talk about the journal entries that go along with what we've been talking about to kind of help it click a little bit more and show you what's actually happening. Let's go to question 4. All right, here we are at question 4. What is the journal entry to record the interest income and amortization of the premium on December 31st, year 1? Okay, so we have to figure out the journal entry for the amortization and everything. Cedar Hills Corp purchased a 3-year bond with a face value of $100,000 for $105,000 on January 1, year 1. The bond has a stated interest rate of 6% with interest paid annually on December 31st. The market interest rate at the time of purchase was 5%, and Cedar Hills Corp uses the effective interest rate method to amortize the premium. So again, with all that, this is very similar to what we've done before, but we have to figure out what the journal entry is going to be for this interest income and amortization and everything. So think about what we've learned so far and think about what the journal entries would be in your head. If you can't figure it out, that's okay, because we haven't really talked about how this really affects the journal entries and how it really affects the accounts. So again, if you don't know how, that's okay. If you want to try to figure this out on your own though, that's great. Pause the video and do it by yourself. And when you're ready, come back. We'll look at it together. All right, here we are. The answer is B. You would debit cash for $6,000. You would credit investment in bonds for $750, and you would credit interest income for $5,250. So let's walk through this. It's not too complicated once you see what's actually happening. The reason we've been calculating interest income and interest payments and things like that is because this is how they are going to affect the journal entries. So the interest income is the carrying amount multiplied by the market rate, and that gives you $5,250 of interest income. The cash received, and again, this is the interest that you're going to actually receive each period from this bond. So this is how much they're actually going to get each time, is the $100,000 par value multiplied by the stated rate. So 6% multiplied by 100,000 is $6,000. So again, this cash received is not going to change each time. And then the amortization of the premium is the cash received less the interest income, and that's $750 in this case. So again, how does that look as journal entries. So you would debit cash. Again, this is the interest received. This is based off of the stated rate and the par value, or the face value, however you want to call it. You would credit investment in bonds for $750 to amortize the premium. And if you think about it, the reason that you're doing that is because when you very first purchased the bond, you debited investment in bonds for the $105,000 that you paid. But as time goes on, you are trying to lower that down to the face value of $100,000. So you're crediting it each time for the premium to, again, bring it down over the years to the correct face value. So you're crediting investment in bonds to reduce it based off of the premium, and that's $750. And then to finish it up, the interest income, which is, again, based off the carrying amount and the market rate, that is going to be the interest income that you actually recognize. So you receive $6,000 of cash, but you only recognize $5,250 of it as interest income, and then the other $750 is the premium being amortized over the course of the years. So that's the journal entry there. That's what we've been doing the whole time. The calculations that we've been doing have been doing this in the background each time. So let's go to the next question to see the journal entry for a discount. All right, here we are at question 5. What is the journal entry to record the amortization of the discount on December 31st, year 1? Okay, let's go up to the top here. Ridgeview Ltd. purchased a 4-year bond with a face value of $200,000 for $192,000 on January 1st, year 1. The bond has a stated interest rate of 5% with interest paid annually on December 31st. The market interest rate at the time of purchase was 6%, and Ridgeview Ltd. uses the effective interest method to amortize the discount. On December 31st, year 1, Ridgeview Ltd. Recorded interest income of $11,520. What is the journal entry? Okay, so again, they are recording all this. Okay, so we're given a little bit more information that time. We have to figure out what the journal entry is. I think that based off the previous question, you can probably figure this out. So pause the video, think through this. It's going to be a little bit different because it's a discount, not a premium. But again, it's not too much different. So pause the video, come back when you're ready. All right, here we are. The answer is B. You would debit cash for $10,000. You would debit investment in bonds, $1,520, and you would credit interest income for $11,520. So again, this is a discount. It's different than a premium. So let's walk through this. It's very similar though. The cash received is again going to be the face value, the par value, multiplied by the stated interest rate that was on the bond. And that's not going to change each time. So you're always going to receive $10,000 of interest as cash from these payments. Then the interest income, this is going to change as time goes on, is going to be the carrying value, the carrying amount each time multiplied by the market rate. And that gives you, again, the interest income. So how does that look down here? You take the interest income and subtract the cash received, and that gives you the amortization of the discount. So again, let's go to the journal entry here. You debit cash because you received $10,000, but because this is a discount, you're going to be receiving less than what the market would have given you. So you debit cash for $10,000, you debit investment in bonds to, again, bring the investment up to the face value as time goes on, and then you credit the interest income, and that's the other side of the equation. So basically what it will typically look like is you debit cash and you credit interest income, and then you're going to debit or credit the investment in bonds for the amortization of either the premium or the discount, depending on if it's a discount or a premium. If it's a discount, you're going to be debiting the investment in bonds to bring it up to where it should be. If it's a premium, you're going to be crediting it to bring it down to where it should be by the end of the maturity. So again, that's what's been happening behind the scenes with all of these calculations that we've been doing throughout the video. Now we've gone over a few different things in just 5 questions. Before we do anything else, let's do one more part of the process called pillar topics. Now the idea behind the pillar topics is as you're going through the questions, you will notice the things that keep popping up. You will notice, hey, I've seen 2 or 3 questions trying to teach me how to calculate a premium on a bond, or I've seen 4 questions trying to teach me how to calculate an impairment loss based off of a premium or a discount. We didn't talk about that in this video, but that is what we're going to be talking about in the next video, so that's why I brought it up. Again, you're going to be seeing things that keep popping up in the questions, so they're obviously important. They're the things that you definitely need to know for the exam according to your review course. So you take a moment during or after your studying of the questions, and you kind of summarize, write in your own words, these pillar topics of the most important things that you learned. And as you do this each day after your study sessions, you will be building the most important things that you need to know for the exam. So with all that, let's go to the pillar topics for this video. All right, here we are at the pillar topics. Now, again, when it comes to calculating the premium or the discount amortization, here's what you do at first. You calculate the interest income by multiplying the carrying amount of the bond by the effective interest rate. What is the effective interest rate? that is the market rate. The amortization amount is the difference between this interest income that we just barely calculated and the cash interest payment, which is calculated using the stated rate on the bond's face value. Now, again, if you paid attention, this cash interest payment, since it's on the stated rate and the bond's face value, that's not going to change each time at the end of each year or at the end of each period when you're receiving the payment. That's going to stay the same. The amortization comes from the difference between this cash that you received and the interest income based on it being a premium or a discount. Now, as far as amortizing a premium decreases the carrying amount over time by subtracting the difference between the cash interest received, which is higher, and the interest income, which is lower. And that's how it's going to be, because you are going to be receiving more money because it's a premium than you would have with the market. So that's why that is going to be amortizing the premium, because again, you paid more because you're willing to pay more, because you're going to be getting more interest than if you had it at the market rate. So as time goes on, the premium is going to be going down and your investment in the bond is going to be going down until you get to the face amount of the bond once it matures. And then it's very similar for a discount, but it's the opposite way. Amortizing a discount increases the carrying amount over time by adding the difference between the interest income, which is higher in this case, and the cash interest received, which is lower. Because again, you are receiving less cash interest than if you had had the market rate. And that's why you add a discount, because it's not as nice. So you're paying less upfront for it because, again, it doesn't have as good of an interest rate. Now, the journal entry for the interest income and the amortization, again, you're going to be debiting the cash for the interest payment received. You're going to be crediting interest income for the effective interest. And again, the effective interest is how much interest income you would have received if it was on the market value. And adjust the investment in bonds for the amortization amount. And that is going to be a debit or a credit, depending on if it's a discount or a premium. And then finally, the initial journal entry. We didn't talk about this, but I want to make sure you kind of know this. To record the journal entry when you very first buy a bond, you debit investment in bonds for the purchase price. Not for the par value, because again, you're trying to amortize down or up to the par value with the premium or the discount. And you credit cash for the same amount because that's how much you paid for the investment. And with that, those were the pillar topics for this video. Before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Again, it's only 1 hour, it is free, and we will teach you the key ingredients to passing the CPA exam. Things like studying in the morning, making sure you review each day, things like that. Make sure that you go check out that webinar and sign up for it. You'll learn a lot, and after you watch it, you'll probably want to become a pro member. Just remember that pro members of SuperfastCPA have access to the full 10-question versions of these 5-question YouTube videos so that members can get more practice and more understanding of these topics. And of course, they get access to a lot of other resources as well. It's not just that. So again, just remember that pro members get access to the full 10-question videos. If you liked this video and if you like our other content, make sure to like the video and leave a comment. Thank you for watching. I hope this was helpful, and I will see you in the next video.